So what we're going to talk about today is foreign currency. And if you are living in Jamaica, if you're Jamaican, if you do foreign currency trading, if you do anything involving a foreign land, foreign currency impacts you, right? And so today, wanted to go ahead and get into a little bit of what is foreign currency and to try and give a better understanding of foreign currency more than, oh, the rate is this and this. You know, there's a little bit that goes on the back end of that. All right. So the first thing is, what is foreign currency, right? Foreign currency is essentially when you go ahead and you make a purchase of an asset from any overseas land. We normally use the US, but any overseas land, right? They want to be paid in their local currency. So for instance, if you are purchasing something from England, they want to be paid in the pound. So you have to purchase that in the pound. If you want to purchase something from the US, you have to go ahead and purchase it in USD dollars. If you want to purchase something in Jamaican, you should purchase something in Jamaican dollars. At the end of this, we'll talk about that. But it should be that it should be purchased in Jamaican dollars, right? Now, so the crux behind all of that is the more that you purchase an asset from overseas, the more demand there is for that currency, okay? So right now, everything is really purchased. A lot of people purchase things from the US. So what does that do? That increases the demand for the US dollar, okay? That's all it is foreign currency is just you making purchases in another country, and the seller of that country needs to be paid in their currency. Okay, so you have to pay them the equivalent in their currency. Okay, so what is currency rates? Currency rates, usually you'll hear of currency pairs, right? So for instance, USD JMD, that's a currency pair, okay? That is usually how you express it. Now, what does that mean, right? USD JMD, right? All we normally say is the Jamaican dollar is going for 153. No, it's really USD JMD. What it is the first thing. So in this one is USD, that is called the base pair. That's called the base. And the other one is called the actual trailing currency, right? So for the base pair, what you're saying is for one of that, it is going to cost X of the other, okay? So in this case, for USD JMD, for one US dollar, it is going to cost 153 Jamaican dollars. Okay, so that is how it reads. You can flip it around and say JMD USD, right? And that is essentially saying for one Jamaican dollar, it is, believe it is 0.006. So it's like 6 cents US dollars. Okay, so that is how you read those things. The first thing is the base, and the other one is essentially how much of that is to get to the base. Okay, so if you see GBP USD, right, at 1.3, that means that it is $1.30 US to buy 1 British pound. Okay, the first one is always the 1, and then the other one is dictating how it's going to run. Okay, so whenever they're talking about something is appreciating or depreciating against the other, it's really in that term. So it is the other, how the other currency is performing against the base currency. So if the Jamaican dollar depreciates, it is depreciating against the USD dollar, okay? Not USD dollar, US dollar, right? So that is how currencies are usually expressed, okay? Now, there are three types of exchange systems, all right? We always know, oh, foreign exchange, and we're always saying, oh, why the government don't do this, why the government don't do that, and those things. It depends on what type of exchange system is your government running, right? And there's three choices. Each one has its benefits, each one has its pitfalls. So let's go through them. The first one is called the fixed rate system. What does the fixed rate system? A fixed rate system is whereby you're essentially fixing your local currency to another, right? So for instance, Jamaica could go ahead and fix their Jamaican dollar against the US dollar and keep it at a 1-to-1. They could do that, right? What is the benefit of that? Well, it's very predictable. You know exactly how much something is going to cost on any given day because it's 1-to-1. What's the pitfall of that? Is that you are artificially valuing your dollar, okay? It is not necessarily, your dollar is not worth $1 US. It is the government, right? And this is why sometimes they would say, oh, the government used off all the reserves to keep down foreign currency rates. Because if your currency actually wants to move away from another currency, you have to pump a lot of money into it to keep on trying to keep it at that 1-to-1. If the rest of your economic conditions, aka the fundamentals of your currency, right, is not saying that it should be a 1-to-1, you have to artificially force it to try and be that 1-to-1. And that can be very detrimental to you, right? One of the countries that have a fixed exchange rate system is China. And China has been using it to their benefit for a long period of time. That's one of the things that a lot of countries have been trying to negotiate with China with, is because they know that the Chinese currency is supposed to be valued a lot more than how it's currently valued. And so they're saying, because they're undervaluing their currency, they're making their products more attractive. All right. So that is a fixed exchange rate system. Now you have free float exchange rate system. What that is government, leave it alone. It is purely working off of supply and demand. It is working no different than a stock on the stock market. It can fly up 1 minute, it can go down another minute or whatever. The disadvantage of that was the advantage of the fixed one, is you have no idea what you're going to walk into tomorrow. There is no predictability on your currency, right? What's the advantage of that? The advantage of that is that you get a sense of the true value of your currency. If the true value of your currency is really supposed to be high, it works out great. If the true value of your currency is really supposed to be low, it doesn't work out too good for you, right? But that is essentially a free floating exchange rate, right? It's where no government intervention, there is nothing else. It is left strictly up to you and me, the consumers and the suppliers, to determine what is what's the equilibrium price, what is the actual value of that currency. Then you have managed float exchange rate system. Now, this is the more popular one, right? This is one whereby governments watch it. They allow it to do almost that free floating but within a wide band, right? Within a wide band. The fixed rate is a very narrow band because remember, they're trying to fix it to a certain currency. With the managed one, they're saying, okay, we'll allow it to float up, we'll allow it to float down, and those things. We want it to keep it within this certain value. And if it starts to go too far below or too far ahead, they'll come in and put in monetary policies and use other tools in their arsenal to try and taper it down to keep it within a managed range, right? So that hence managed float exchange rate, all right? So what the managed float exchange rate system is essentially a combination of the fixed exchange rate, which is essentially all government intervention, and free floating exchange rate, which is all market. So managed is what you normally see. That is why everybody's always trying to pay attention to what are the central banks going to do? Are they going to come in? What are they watching and those things? Because they come in and do something when something is needed, okay? Now, exchange rate purchasing power. Well, if, for instance, in Jamaica, as the currency goes, as the currency depreciates, which means it takes more Jamaican dollars to get to $1 US. What that does is that it, even if in US, the prices have not increased, because of that devaluation to Jamaicans, that price has increased. Therefore, depreciation of the Jamaican dollar decreases the Jamaicans' purchasing power, okay? So if in the US, let's say a candy bar, it costs $1. A few months ago, it would have cost Jamaicans $148. A few weeks ago, it would have cost Jamaicans almost about like $156, $158. So that in itself can cause an issue. However, you can have the flip side. You can actually have where the dollar appreciates. Now, due to our economy, you don't see real big appreciations. But in essence, if the Jamaican dollar was to, let's say, do a big appreciation against the US dollar, that same candy bar that had cost 148 a few weeks ago could cost $120. No, right? No, one thing you have to realize, no country wants their dollar to essentially be so astronomically high, right? Why don't they want that? If their dollar is too powerful, the demand for their goods is going to go down, okay? So I know there's a lot of conspiracies out there and people are thinking, oh, this currency, they must be enjoying the fact that their currency is also powerful. No, because it hurts them, it hurts their trade, right? If the pound gets much stronger than the US, what's going to happen? US consumers are going to look to other countries, other means to substitute those products if they could be substituted and purchase it that way. That means companies over in England are not going to be getting as much money. They might have to close down and then it causes issues, okay? So contrary to what some may believe, countries do not want their currency to go too high when compared to other currencies, all right? All right, now, what affects currencies, right? And this is something that I think is very important because many people say just about every time the dollar moves, you're hearing, oh, why can't government do something? Oh, the government making it run. Oh, I can't believe government doing this. No, right? It's just like inflation, right? It is not all on government. Not every single problem is solely government's issues, right? So we're going to go ahead and we're going to talk about what are the factors that impact the currency, right? There are two overall things. One is trade-related factors and the other one is financial-related factors, right? Under the trade-related factors, you have relative interest rates, you have relative income rates, government intervention. Under financial factors, you have relative, it was relative inflation rates under trade, sorry. Under financial factors, you have relative interest rates, and then you have ease of capital flow, all right? And in that graph, what I'm showing, this graph is actually the index of the US dollar over a period of time. I think I just did the graph on a 4-hour time frame. So that's probably what it looks like. That's since May, right? And as you can see, the graph goes up. Why is the graph gone up? Well, there were some economic factors, but the underlying thing of each of those factors is the demand for the US dollar went up. And when the demand for the US dollar goes up, boom, you see an increase in the graph. All right. So let's dive in deeper into these things. So we have trade-related factors. Trade-related factors, let's get into it. When the rate of inflation of one country is much higher than the other country, the country with a higher inflation rate is going to go ahead and depreciate. Why? Because the cost of the items within that country with the high inflation are going to go up, are going to become more expensive to the other country. Okay, so for example, let's work with Jamaica. Jamaica is working with around a 4.3% inflation rate, right? Now, we've all seen, well, I don't know if we've all seen, but there've been memes and images going out talking about oxtail, right? And how much oxtail costs, and in the US, how much they have to pay for oxtail. What is that going to do, right? That is going to go ahead and decrease the demand for oxtail. So the people in the US who normally buy oxtail are not going to buy oxtail, which means the demand for the Jamaican dollar for the price of oxtail will now go down. Okay, and if the demand for the dollar goes down, so does the value of the dollar go down. Okay, so that is why countries that have really high inflation rates tend to have lower value currencies, because the cost of their items tend to cost more. Okay, so that's how inflation occurs. Now, the other one is relative when it comes on to incomes. Okay, if, let us say, in the US, incomes grow. I mean, they're looking, let's say incomes increase by an average of 5% for everybody. What are they going to do? A lot of them are going to go ahead, they're going to start to travel. They're going to travel to Europe. They're going to travel to the Caribbean. They're going to go ahead and take their money outside of the country. Now, when they take their money outside of the country, are they keeping it in US? No, Jamaica is the exception. But what they're doing is that they're converting their US dollars into the local currency of where they're going, which in turn is increasing the demand of that local currency and causing that local currency to appreciate again. So for example, if a lot of people in the US want to go ahead and vacation in England, you're going to convert your US dollars into the pound. Now, the more that the US is traveling to the UK, the more demand there will be for the pound, and the pound will now start to go up in value. Why is that happening? We've talked about this in the past. Supply and demand, right? There's just some, for currency is not never ending, okay? The central banks usually tend to determine how much money is in the system, and we'll move on to that in the next point. So if there is a limited amount of supply and you have all of these people coming in and converting and needing pound and needing pound and needing pound, well, in order to meet the needs, you're going to bump up the price of the pound, okay? So that is how it also works with shopping online and all of those things. As income increases, people tend not to say, oh, let me spend it in my local community. They tend to say, let me spend it overseas. Okay, so that is how incomes can affect the foreign currency. Then you have governments. Well, what a lot of governments try and do is they try to regulate the currencies in manners regarding trade. So what they'll do is they'll issue tariffs, right? To try and, because what they want to do is they want to try and balance the imports, right? Because the imports mean that you have now purchased outside of the country, which is increasing the demand for the foreign currency, not the Jamaican dollar, right? So what do? Put tariffs on certain things, put a tax on it to try and make people not want to import as much, make them try and look for local means and increase the demand for the local currency than for the foreign currency. The other thing they'll do is use monetary policies. We talked about a little bit of that when we were talking about inflation. Is when going through an expansion period, they tend to let more money into the system. When more money goes into the system, you increase the supply, you drive down the price of your currency. During a depression, right? You want, during an expansion, you want to start to take money out of the system. You want to start taking money out of the system. When you take money out of the system, you increase the price of your currency. When you go ahead and put money into the system, you drop the price of your currency. Okay, so that is how, when they're going ahead and combating inflation, it also impacts the price of the currency. Financial factors. Now, the financial factors, a lot of times, don't really have too much to do with government, right? We just talked about the government intervention. It was just that. That was it. That one bullet point. So when they're saying, oh, it's the government, it was just that one bullet point. The rest is all us, right? When you look at interest rates, if a foreign currency, if another country has attractive interest rates, right? What are you going to do? You're going to go ahead and try and take advantage of those foreign assets, those foreign investments, and those things. When you look at Jamaica, it's going through a construction boom. If you're a foreign investor, that looks very attractive to you, right? So you go ahead and put money into that system, which increases the demand for the Jamaican dollar, which now pushes up the price of the Jamaican dollar, right? So that is why you will hear when people get all excited when they hear about foreign investors coming in. They like that because it makes the country look more attractive. And if the country is more attractive, it will increase the demand for the local currency, okay? So that is really it. So that is how interest rates impact it, right? The other thing now is when those higher interest rates is tied to ease of doing business. That's another thing they talk about in Jamaica, is how easy it is for people to come and invest in Jamaica, how easy it is for you to invest in a foreign land, right? How easy or hard is it for you to move your money from one country to the next. A popular example, what are the two most popular countries that people like to move money to? The Cayman Islands and Switzerland, because their barriers are extremely low and they have very attractive interest rates. So when you look at those currencies, you will see those currencies are extremely strong. Is it that they're doing a lot of construction? Is it that they're doing all of these economic developments? No, they just have a lot of foreign investment coming in, and therefore the demand for their currency is extremely high, which keeps up the value of their local currency very high. All right. So that is how financial factors impact the currency. All right. So I know I went in a bit deep into currency, and the main thing is for you to understand that when thinking about currency and thinking about, oh, the value of this currency versus the value of that currency, you realize it's a currency pair, right? And this is what I try to explain to people. It's a currency pair, which means that what happens in any one does not dictate everything, okay? So take, for example, the Jamaican dollar versus the US dollar, right? You saw where, because of inflation, Jamaica has a higher inflation rate than the US. US tries to keep an inflation rate of about 2 point something percent. Jamaica says that they're okay with a 4 to 6% inflation rate. That's already creating a gap that will cause our currency to depreciate, right? The other thing that we love to do is, in Jamaica, they like to request payment for services, payment for rent, payment for goods in US. What does that do? When you have to pay your rent, when you have to get paid for your services in a foreign currency, you're increasing the demand for that foreign currency, further devaluing your dollar. Okay, so when you go online and you see all of these properties and they want 1,200 US, and they're actually helping to devalue the dollar. So it's not, oh, it's just the government, it's actually us as the people. Whenever we get a raise, whenever we start getting more money, what do? We don't go to the local stores to buy our clothes and those things. No, we go ahead, either book a flight and go to Miami and buy things, or we shop online. Both things is increasing the demand in the foreign currency, therefore devaluing your local currency. Okay, so I hope with this conversation I give you a little bit more insight into foreign currency. Next week, we're going to still stay on foreign currency, but we're going to move into a little bit on how is foreign currency actually traded, right? And what's going on when people say that they're trading in Forex. Okay, so thank you guys for coming out. I will have to upload 2 videos tonight, because I didn't upload the last video yet. So I promise I'm going to upload both videos tonight. So make sure that along with subscribing to my channel, you also subscribe to and put on your notifications so that you know when I've uploaded a video. All right. Thank you guys. See you next week.